So yesterday we had two massive pieces of news coming out from two of the largest central banks in the world. The first was obviously the Federal Reserve, and it was regarding their 75 basis point rate hike, which is the highest we've seen for over 2 decades. And the second piece of news came out of the European Central Bank, who had to host an emergency meeting just 1 week after they announced that they would be hiking rates in the future and that they'd be ending quantitative easing. Now today we're going to look at exactly what was said by both of those parties. We're going to listen a little bit to what Jerome Powell had to say, and then we're going to take a look at what he's saying that's actually truthful, what he might be leaving out, and then finally we'll look at the entire situation over with the ECB, because it's something that we haven't covered an awful lot on this channel. So we'll describe exactly what's going on, what the problem is, and how the ECB plans to fix this problem and why their plan will fail. So to start off, the Federal Open Market Committee came and went with a 75 basis point rate hike, as pretty much everyone expected. Powell also came out and made a 10-minute speech followed by about an hour-long Q&A where he answered a whole load of different questions. Now I've trimmed down the speech that he made to just cover the important bits, and then I'll cherry pick out some of the interesting Q&As and we'll look at them as well.
I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point, and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now.
Now, there were a few other things mentioned in his long question and answer session as well. So what were some of the interesting ones? Well, one of them was this idea of the soft landing, the idea that the Fed can bring inflation down while not necessarily causing a recession, and whether or not that possibility is still on the table. Now, Powell was very clear, and he said that yes, it is still a possibility and it is what they are targeting. The simple reality is, though, at least in my opinion, from what I can see, is that actually, no, he's not telling the truth here. There is no chance of a soft landing, and he probably knows it as well. Consumer sentiment in the US, i.e. how consumers feel, how people who actually spend their money and send the economy moving round and round, how confident they are about the economy, well, it's literally never been lower in the entirety of American history. Mortgage rates are encroaching on 7%, which will absolutely decimate demand for housing, especially in many of those cities like Boise, Idaho, that have seen monstrous house price growth over recent years. GDP growth in the US has already seen negative figures the last time we actually got data out, and now some other Fed presidents are expecting the next month to see negative figures as well. Take a look across the pond at Europe. Well, in the UK and France, for those two most recent figures, they've both seen negative GDP growth as well. On top of all that, inflation is still ridiculously high at 8.6%, and it's driven right now mainly by energy prices, which aren't really falling. So in short, no, there just isn't much chance of a soft landing. There is too much going against the economy right now, both in the US and the rest of the world, and Jerome Powell is sort of forced to tell a lie here. He can't literally come out and say that a recession is coming, because it would then literally become a self-fulfilling prophecy and would crash the market, but we all know what's really going on. Now, the next thing he said is a little bit related to that, but he was asked whether or not they are actively trying to induce a recession at this point, and again he said no, and again I don't think this is really being genuine. Everyone really agrees at this point that the supply chain crisis is out of control in a literal sense. We physically can't control it. People and governments have been trying to improve the state of the supply chain crisis for years now to no real avail, which means the only option to actually tame inflation isn't to bring supply up, because we can't do that. It's to bring demand down. It's demand destruction. And ultimately what that amounts to is causing a recession. It's reducing economic growth in order to ease buying pressure. So I don't think it really is fair for the Fed to claim that they're not trying to induce a recession, because actually they kind of are. Again, though, I do understand that Jerome Powell can't literally come out and say this. Economics is incredibly nuanced, and if 90% of the population heard someone with this position of authority say, I'm trying to create a recession, they wouldn't really understand what's really going on, and they'd probably start rioting in the streets. Finally, then, we have Jerome Powell mentioning that actually the Federal Reserve is acting in the interest of their dual mandate, and that they always have acted in that interest. And again, I just don't think this is true. I think that the Federal Reserve is purely acting to try and maintain asset prices at as high a level as they physically can. They ignored inflation for months on end and continued pumping stimulus into the economy, into an overheating economy, despite what everyone was telling them. The only reason I think they're fighting inflation now is because the markets are more afraid of inflation spiraling out of control than they are afraid of rate hikes themselves. This is an act of self-preservation. The Fed is still acting in the interest of their secret mandate of maximizing wealth and maximizing asset prices. It just so happens that it's coming about in a roundabout way. Now, the markets obviously liked what Jerome Powell had to say at first. We saw a really strong rally yesterday with the indexes rising in the region of about 2%, but it seems that they finally found some sense. And I said earlier on in my video that came out earlier today before markets opened that this rally wouldn't last, that it was a bull trap, and we're already seeing that be the case with the S&P 500 falling by 3% so far today, and the markets have only been open for about 3 hours at the point of me recording this video. Now, if we move on over to the continent across the pond over in Europe, what's going on over there? Well, there's something brewing that they're calling a debt crisis, and it's worrying for the entirety of Europe, but in particular for the lesser economically developed countries. The southern countries, Spain and Italy, seem to be the big ones that most people are paying attention to. Now, the basic idea here is that debt is getting really expensive, and in particular sovereign debt, which means that government spending is getting more expensive, and that's worrying for these governments. Now, regarding Italy and Spain, over the last week, they've seen their bond prices rise to their highest levels in 8 years, which of course makes running their governments more expensive. They have deficits, and those deficits need servicing. Now, last week, the European Central Bank finally came out and said that they will stop buying bonds, they will stop their quantitative easing, and they will raise interest rates, so they will start quantitative tightening. Now, this is long overdue. The European Central Bank has been absolutely asleep at the wheel when it comes to inflation, but it is good to see them finally act. The only problem is that was literally 1 week ago, and they've already seen trouble from that announcement that they made. They haven't even started raising interest rates yet, but already European markets are panicking. In order to try and fix this panic, the European Central Bank have said that they're coming out with a new bond buying plan to try and counteract these rising yields. And we're not 100% sure what it is, but the consensus amongst people involved in this market and connected with these people is that they're basically going to buy 200 billion euros worth of sovereign bonds from countries like Italy and Spain in order to raise prices and reduce yields and try to help these countries be able to actually service their debt. Now, 200 billion euros is a lot of money. That's about $210 billion in today's money. And if you remember, the US is going on quantitative tightening, and they're going to be selling about $45 billion worth of bonds every month. So if this is carried out over the course of the rest of 2022, give it a few months for it to set up, this is pretty much enough to counter the entire effort of the Federal Reserve's quantitative tightening. Now, of course, this money wouldn't actually be paid for. It wouldn't be paid for by taxpayers. It would be printed out of thin air, which means the European Central Bank wants to pump Europe with more financial liquidity. This is basically quantitative easing. They're just not using that name, and they're targeting it in specific countries that they claim need their help, like Italy and Spain. Now, why is this such a huge problem, and why will it end up being disastrous? Well, because quantitative easing causes inflation. Those modern monetary cultists cannot claim otherwise anymore. That has been thoroughly disproven, and inflation in Italy and Spain is already bad. How bad is it? Well, in Italy, it's 6.8% right now, and in Spain, it's 8.5%. These are not levels that you can mess around with. These are not levels where you can just pretend they don't exist. You need to bring inflation down. Frankly, though, there isn't really a solution here. The euro has a fundamental flaw. It's a monetary union between over 20 different countries that each have different needs and wants. The simple fact is that Germany and Denmark and the Netherlands are fundamentally different to Greece and Italy and Spain, and having a single currency shared between them all means they cannot set their individual interest rates, they cannot make individual decisions about quantitative tightening or quantitative easing, and so some countries always lose out, and in most cases, every country ends up with policy that they don't 100% agree with. The sad thing about all this is that it will spike inflation all over Europe, but as is always the case with inflation, it will be the poorest people who are hit the hardest. It will not be President Lagarde, the head of the European Central Bank. It will not be any of the politicians in any of these countries or any of the members of parliament in the EU itself. It will be the ordinary innocent people who can't afford to fill up their cars with petrol, who can't afford to pay for their groceries that they used to be able to make no problem at all. It will be the normal people who watch YouTube videos like this who will suffer because of the European elite's hubris and their irresponsibility. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.